Join Samantha and Hans at the next Macro to Micro Options Power Hour, held each Wednesday at 4 p.m. Eastern Time. Registration is free. Scan this QR code or click on the link in the description.
So basically, we're coming together here on finally a balmy summer feel post taking the weekend off, which is to say, I exited on Friday afternoon and came back Tuesday morning, and we had our quintessential birthday rally on Monday. So it always, if you look historically, I don't know why, we have a rally on May 12th pretty much every single year, and this one was a doozy. So we got some nice trade war de-escalation out of Geneva, which had probably been in the works for the past few weeks. And anyway, resolved itself into this very hopeful backdrop of US reducing Chinese tariffs down to 30% from 145 or 80 or whatever. But remember, they already have 19% in existence under Trump 1.0 back in 2017. So we're not really out of the woods yet. This is still very chaotic, especially for small, medium-sized companies to try and plan around supply chain drama. And it is only a 90-day reprieve. So we had one that came in, the infamous April 9th. We caught actually live intraday, which was very sweet. But when Trump said he was going to delay basically the rest of world tariffs for 90 days. So those will trigger on July 8th, I believe. And this latest round, which is very focused on China, is a delay of 90 days, which will trigger about August 10th. Ironically, we have some macro event risk around that same time frame, which is this tax cut and debt ceiling lift, which is required right now for the market to kind of be very hopeful moving forward as it relates to DC. But they're having a really tough time getting this through. You've got some diehards that want some deficit cuts, and that is not what this bill is about. This is absolutely extension of the Biden tax relief and also the Trump tax cuts extended. And it's an increase of 1.5 trillion over the next few years. So it's definitely a reason why bonds cannot catch a bid and yields stay very firm. So anyway, we got a macro event risk coming up in that bill, but it's not a defined date. And then we have the trade tariffs, basically relief rally, and we've had a heck of a rally. So long story short, we went into my and through my VIX 20 target, which was basically my tell that we could stay long, and we went right through it. So we crashed right into the 18 handle, and we could even go into 17, 16. That's what I want to talk with Hans about, since you are a study of all things VIX, and also your option positions have been just doing extremely well in the Bitcoin realm, in the tech realm, because we've had this very strong growth rally. How long can this go, Hans? Inquiring minds want to know.
Well, we've been talking about this. Hello, everybody. Hi, Samantha. So yeah, it's just been flinches, right? The flinches heard around the world, one after another. And so I think what the weekend did is it really pulled forward some of the remaining uncertainty. You mentioned some uncertainty around July and August, and for sure, those are going to be issues. Right now, that is not top of mind for the market. What is top of mind is really that the crisis of confidence, the growth scare, some of those really big issues, the existential risk, as I called it a few weeks ago, is off the table, right? And so it wasn't really anything that broke the economy. What's so interesting about it, nothing really broke. The financial system didn't break. It wasn't something in the economy that went bad that sort of compelled the market to react to it. It was something that was an intentional we call it an own goal. I don't know if they use that in soccer, but in hockey, it's an own goal. You scored on your own net and you shocked people. You broke confidence. It was very abrupt. Not in the sense that tariffs weren't expected. We knew that Trump had talked about tariffs, but it was the level of aggression, the sort of almost radical, thoughtless manner in which they were suddenly being used. Every country targeted and all these crazy numbers, 145%, and we're not even taking phone calls. Don't even call us. We're not interested. It was really shock. And I mentioned, even on our show about a month ago, I said, maybe there's a chance that this is a paralysis. So we saw confidence fall off a cliff, businesses, consumers, everybody. And I said, it wasn't anything actually to do with, at that point, or at any point in the near future, it wasn't anything to do with people not being able to continue spending. The economy was generally okay until all this happened. And so it was this shock and paralysis that was brought into the situation.
A bunch of folks dialed it back. Yardeni was very cautious. All of a sudden, he was not pricing in any any recession risk at the beginning of the year. A big soapbox I stood on was, hey, nobody's pricing this in. They're going to be in trouble. And then BlackRock actually said we were in a recession just 3 weeks ago. And Apollo increased the recession odds to 90% starting this summer. All this did right now was push it out. So this stagflation risk has to be ratcheted down a little bit because they pushed it out. The recession risk also has to be pushed out. Doesn't mean that tariffs are going to go away and they're not going to be disruptive to supply chains and to the labor market, but it has been pushed out. The growth scare has been pushed out. And we're going to talk about the mechanical buying that's part of this, not as much fundamental buying. We have talked about this every single week. Mechanical buying, these are CTAs, these vol strategies, not to mention just good old-fashioned price-insensitive quants, and they have been in the house. And then we got some hedges that really had to unwind after this gap up on Sunday night futures. We can't really just go with a particular sentiment narrative that fits. There's a lot of buying that happened underneath the surface. That was one of the reasons why we were bearish VIX and bullish the market into this level.
You mentioned Apollo. He loves to be a bear. Stock loves to be, a bull rather. He loves to be a bull.
I was going to say, what?
Yeah, sorry. He loves to be a bull. And it was just an about face in so many ways. And now it's funny, like dominoes, they're pushing everything up again.
Well, he did preface this. He does see a 30% chance still. So he didn't unwind all of that bet. And more importantly, we still don't have, we have a mercurial president as it relates to these tape bombs. And we still have fiscal dominance, which I cannot underestimate as it relates to rising yields. And we have, even when I came in Tuesday morning, I'm like, hey, look at the 10-year and the 30-year. We're right back almost from this infamous April 8 bond crash, where the 10-year had a very fast spike from 3.9 to 4.5. That was a rate of change that actually interrupted some think basis trade. It was reported in Wall Street Journal or one of them, Reuters, that was actually swap trades that got out of control. But the point was, you do not go from 3.9 in the 10-year to 4.5 in 3.5, 4 days without breaking stuff. And that's what froze the credit markets and liquidity. Equities also froze, right? They needed to come in the next day and calm bond and equity holders to stop selling. And that's exactly what they did. And we had that 10% intraday reversal. But I don't think this is a safe bet. And I'm commenting on one of the questions in here that we have seen the lows. I absolutely don't. This is almost a reflexive rally you can size up. When we saw the VIX finally break on April 22nd, anyway, when it got back below a very key level, which happened to be strangely 19, when we got up 30, what was it? We did this live. Anyway, it was a really key level. And I'm like, okay, so now we can fade into OPEX just like we did in March. So we faded into that March OPEX, then we ran VIX back up, and then we faded back down into April. So we can do this again. In fact, I think we'll have another opportunity in July. But to answer your question as it relates to the George Noble podcast, yes, I absolutely think we're going to roll back over into Q3 and we will revisit not just the 48.78, but I think we'll take that out. So 4,800 is really strong support, but it would not surprise me if we take that out and go all the way down to 4,000, depending on how recession risk really starts to fashion itself. Because remember, at the beginning of the year, they had zero recession risk priced in. We're all the way back up, nearly a few percentage points away. Yeah. But has anything changed? Is there a real big growth narrative to get us moving higher with higher tariffs and still uncertainty and supply chain risk and recession risk? And now we've got household getting crunched and delinquencies going higher. So now we have to focus after this gamma squeeze on the real economy. I definitely don't think we're out of the woods, but I think this is a very nice opportunity to reset shorts into the end of the year.
Join Samantha and Hans at the next Macro to Micro Options Power Hour, held each Wednesday at 4 p.m. Eastern Time. Registration is free. Scan this QR code or click on the link in the description. Watch the full Options Macro to Micro Power Hour episode by clicking on the video here and subscribe to LaDucTrading YouTube channel for more content.